All right, so welcome to chapter 2. I want to believe chapter 1 has laid the foundation for you of all that we're going to be doing in this course. Now, I'm going to be taking you through, chapter 2. And what we're going to be looking at is developing your edge. So mind, money, and method. Okay, so the next level, psychology and the mechanical dimension. Now, developing your edge, mind, money, and method. What do I mean by that? If you think about trading, one of the first reason I believe you're trading is you want to make money. Okay. But to make money, there is a method to it. And then to effectively apply that method, you need to have a good grasp and control of your mind. Okay. And that's what we're looking at, the mind money method. Okay. Now, mind, that's your psychology. And that's essentially this course. Your psychology is the critical, I'll say, the centerpiece of your long-term success as a trader. If you're able to master your psychology, then money simply follows after. Okay. Now you take responsibility, complete responsibility of your mind. Whatever you do, you learn to deal with your emotions and psychological biases. Okay. These are things that you've learned. And as we go through this course, I'm going to be showing you practical step-by-step methods that you can actually use to do that. Now, you always keep a positive attitude. That's one. Now, most traders, retail traders, come into the market and they just jump into the market and just buy and sell. No, you need to be able to visualize what you want to achieve in the market in a particular day, on a particular day. And that helps you to have the right positive attitude that you're going to succeed in the market. Because everything happens in the mind and then flows to your fingers and then to your screen when you execute on the screen. So if you're able to keep a positive mind, a positive attitude, then you can actually achieve a lot. Now, you also have to learn how to set realistic trading goals to achieve better trading results. I've talked about this in chapter 1. If you don't have the right trading goals, then you'll be able to achieve the right result. If your goals are not properly set within what is reasonable, then you would simply just push yourself to the edge where you cannot achieve your goals. And this is what I mean. If you come into trading and you're focusing on the money and you're not focusing on your mind and the method you need to actually implement to achieve the money or to get the money, then you just mess up yourself. So your trading goal has to be realistic. Nothing like I'm going to become a millionaire in the next 1 month. It doesn't work. Okay. If your mindset is right and you actually set realistic trading goals, okay, I'm going to focus on learning. I'm going to focus on mastering my mind. I'm going to focus on my psychology. And in the next 2 to 3 years, I can become a millionaire. That's reasonable. Okay. If you put in the work. Now, money simply refers to money and risk management. You must have heard where it is said that risk management is one of the greatest tools you can have in your arsenal as a trader. Okay. If you have risk, if you're able to manage risk, then you can actually go really, really far in your trading, because you have to be able to preserve capital to really trade long term. And never mind, because that's the whole essence of this course. I'm going to show you practically. In fact, what I'm going to show you is going to be a life changer. Sincerely, when I got inspiration to share that, I felt like this is going to be a life changer for so many people who are able to lay their hands, on the blueprint. So I'm going to share more with you. But money and risk management, define what success means to you. You have to define that. You also need to understand that losses are part of your trading journey and it's important to accept them. No, there's no trader that doesn't take losses. Okay, all traders take losses, no matter the level of psychological, mastership they have attained. Will all take losses. Now, your system should also take into consideration risk and reward. So, 1 to 3, 1 to 2, 1 to 4. For me, I believe 1 to 3 is a sweet spot. So just take, with something like that. Of course, other people do 1 to 2, depending on the trading strategy. And if they have results to show that it actually works, that's great. But 1 to 3 is usually a sweet spot. Now, the method is your trading plan. And of course, the journaling system you have. You must have a trading plan. What should I do? How should I do? And all of that. You must have a trading plan. That is very important. And of course, journaling your trades. Now, at the time of recording this video, we're building an app for Paruto Capital and it's called Chatomic. So that's going to be our trading app. So you hopefully would have access to that. if at the time of watching this video it's already live, maybe you have a discount code or something of that nature to access it. But you must have a robust trading journaling system that helps you to, because this is business. This is not a joke. This is serious work. And if you're going to succeed long term, you have to take it as seriously as possible. Okay. Now your plan should be mechanical. Your entry, your trade management, and your exit models should be very clear. I'm going to trade 1 to 4, and after 1 to 4, no matter where the market is going to, I'm done. 1 to 4, that is it for me. I'm going to do this, I'm going to do that. I'm only going to take one loss during London session. If I take one loss, I'm not entering another trade again until New York session. You have to define all of these things, because these are the things that would help you succeed in the long term. Now, you also have to utilize split screens where possible. So if you're using, for example, TradingView and you're subscribed to it, you should use split screen so you can see maybe 4-hour, the 15 minutes or the 5 minutes. You're able to do multi-analysis and see all of these things at the same time. So they're usually really helpful. And they always zoom out after execution, right? So after you execute a trade, sort of pull out. Okay, don't be there just trying to, palpitating and all of that. Learn how to zoom out, of the whole situation. Then backtest your system and gather rich data. Now let's look at the probability of trading like a casino. Now, trading is a game of probability. You already know this, most likely, right? So trading is a game of probability. And in that sense, what you just want to make sure is that you always have the probability is always on your side. Okay. And this would only come when you understand, of course, your trading system, you have a strategy, you backtest it, you have the data, then you begin to understand how probability works. One loss is not the end of the world, does not erase all the wins that you have made and you can still make. Okay. So now the probability of trading is this. Every successful trader knows that any trade he executes may bring either profit or loss. There is no single trade I execute that the first I'm thinking about is only my profit. I know I may also take a loss. So already I'm willing to lose that amount of money. And that's very important. If you're not willing to lose that amount of money, that simply means you're either over leveraged or you have no risk management in place. And that would be unfortunate, right? And that's the whole essence of this course. So if that is the case, you have to understand that number one, you need a very good risk management. How much are you risking per trade? And you have to define all of that. Okay, that's very, very important. Okay, now you also, if you trade long enough, what you will also quickly come to appreciate is great traders place immense value on odds and probabilities. Okay, so odds are the foundation of statistics, right? So your odds, basically, you want to make sure that you always increase your odds for success when you trade. And you can only achieve that if you have a trading plan. If you're also following a strict strategy that you stick to, you don't deviate from, then you increase your odds for success. Okay. Now, the casino mentality is completely different from the gambler's mentality. The gambler is often desperate to change their financial life. And this is how many people come into trading. Just want to say, oh, I have this thing to buy, I have this bill to settle, and I think trading is going to make me achieve that. I'm a proof, and I'm going to tell you straight up that if that's the mindset you have, you need a job. You need a job. Simple. Go get a job. Let the job settle your immediate financial problems while you learn trading and master trading to replace your job. Okay? If you have that mentality, that casino mentality of I'm just going to flip this amount of money, I'm just going to make this amount of money so I can settle this and this and that, you're simply just going to end up a gambler trading. There are gamblers who trade, okay? But you don't want to go that route. You want to be a professional trader who is measured, who understands what he or she is doing, and you have a robust system that's just repeatable for the long term. Now, the gambler is often desperate to change their financial life. That they live for the thrill of going all in the hopes that that Lady Luck bestows fortune upon them. On the other hand, the casino is focused on its edge. Okay, so be the casino, don't be the gambler. All right. Now, most traders ignore the important relationship between trade size, risk, and reward. When these factors are isolated and mathematically sound, you're looking at a winning formula. And I'm going to give you that formula. I tell you, it's going to blow your mind. All right. So now beginning traders versus, professional traders. Beginning traders make the mistake of waiting for, setups which have 60 to 70+% accuracy, which is also great sometimes. And trading at 1-to-1 or 2-to-1 reward to risk. You could have a system which is at 5% accurate, we still makes money, and a lot of it over time with the right risk to reward. All right, so just need to check something here. I just got an alert. Okay, trying to get into some trade. All right, so now positive expectancy is also something you should understand. Now, trading is like thinking in probabilities and finding setups that make money over not just 1 or 2 trades, but over 1,000, over 10,000, over 100,000 trades. Okay, so you simply just want to find a profitable strategy that actually works over 1,000 trades, and then you use that strategy. That's trading, and it's a game of probability. So if I take 1,000 trades and I win 500 of those trades, that simply means that, let's assume that I risk $1,000 per trade, and out of 1,000 trades I win 500. That would be 50%, right? Now that means I would have made 500,000. Let's say I lose 1,000 of those trades, so I won 500, I lost 500. That would be that would mean that I lost 500,000, okay, dollars. But if I won and my risk to reward is 1 to 3, for example, that would be 500 times 3,000. Okay, that's going to give me 150. Am I correct? 150. Am I doing the correct thing? So that would be 3,000 times 500. That's going to give me 1.5 million, right? So I lost 500,000, but I made 1.5 million. That's positive, right? So trading is a game of probability, and you just have to think in that context. So the casino, for example, knows that you have a lot of gamblers coming in. So they don't focus on one particular individual. They focus on the large number of gamblers, basically, who, are going to gamble, and then they have the edge, of making most from the market. So most traders aren't going to make it because they ignore the simple foundation concept. The expected reward must always be greater than your risk. And that's why 1 to 1, 1 to 2 for me, it's a little bit not the best. Go for 1 to 3, and your strategy should be able to show you that it works over time. If you trade that stock and profit strategy, which I teach in the mastery course, trading basics and mastery course, I tell you, you definitely know that this is not a problem at all. Now, hope is not a strategy. So when you're trading, hope is not a strategy that I hope that this is going to happen. That is not a strategy. You want something much reliable, something that really, really works in the long term. Now, great traders focus on 4 essentials: probability, risk, reward, and edge. So you know that trading is a game of probability. You understand risk. You're not afraid. When you enter a trade, you become fidgety. If that is the case, that means you don't understand risk. You're afraid. You're scared. You haven't really analyzed what you can afford to lose. Then you understand reward, and you also have an edge in the market. So what is your statistical expectancy based upon your last 100 trades? So you have to ask yourself that question. Have you been able to, at this point in time, if you're taking this course, you should have taken about 100 trades. And if you're taking about 100 trades, did you follow your trading strategy? Okay. And what is your statistical expectancy? You should be able to get some ideas there. Now, do you have an edge in the market? That's also something you need to ask yourself. If there's no edge in the market, then your trading strategy, it's basically nothing to write home about. You need to change it. You need to start using the stock and profit trading strategy. I'm just going to say that straight up. And if your problem is that you skip some trades, you take some trades and all of that, that's the essence of this course. And by the end of this course, you'll see how I'm going to help you and get you to that place where that becomes inconsequential. That's a promise. So what has your performance been over the past year? That's also a question you should ask yourself. And no, because that's only what is going to drive you to be better. Now, trading sins you must avoid. Okay, so this is the last one we're going to look at, before we go to the next chapter. So trading sins you must avoid. Number 1, don't trade without a plan. I've mentioned this again. If you trade without a plan, then you basically are not doing it right. You must trade with a plan. You must have a plan. Your entry, your exit, your loss, how your risk, and all of those things, they must all be outlined clearly without any ambiguity. Now, don't forget your trading journal. That's also very important. You should learn how to journal your trades. If you're not using Chatomics at the time of recording this video, our trading journaling app, it works. But if it's out already and you're not using it, then you're missing a lot. Go to chatomics.com and you'll be able to register and begin to journal your app, your trades. Now, don't ignore high impact news. Some traders will say, oh, NFP is going to come out, CPI is going to come out, I'm going to trade it. And then, because that's just gambling, you don't really know where the market is going to go to. There are times when structure will tell you where the market is going to go to. But even at that, you must protect yourself such that when the news is coming out, you must be at break even. You don't just say, oh, the news is going to come out because I'm very confident it's going to go in this direction. Then you don't even break even your trade. You're not, you don't protect yourself. Sometimes the market can go in your direction. Sometimes it can go otherwise. So you must not ignore high impact events. Then don't break your rules. This destroys a lot of traders. It's easy, right, to break your rules. And that is why you have to master your psychology for you to make all of those propensity that makes you try to break your rules as minimal as possible. Okay. Now, don't revenge trade. Now, these are part of psychological issues, right? I'm giving a lot of don'ts, but I'm going to show you the how, right? So just bear with me. So let's go through the don'ts. Don't revenge trade is going to destroy you. Don't be greedy, because sometimes, let's say you're targeting 1 to 3, price gets to 1 to 3 and you say, oh no, I think it's going to go to 1 to 10. And then you become greedy. Instead of you to now lock in your profit at that point in time, you now allow the market to go. And then when it just goes up, it reverses on you. You end up at a break even. You become angry. You want to revenge trade, or you even end up in loss. You become angry and you revenge trade and take trades back to back to back to back losses. So by the time you now make profit the next time, you're simply just recovering the losses you shouldn't have made in the first place. So don't be greedy. And that's why you must have fixed take profits. Now, don't over leverage, okay? At the time of recording this video, we had a very strong price action on Bitcoin over the weekend, and a lot of people lost a lot of money. In fact, because of course, a lot of gamblers trade crypto, there was a situation of a young guy who even killed himself, committed suicide because of the money he lost, about $30 million. According to the news anyways, that he killed himself, Ukrainian guy. So this is how people just, over leverage in the market, and then they just destroy themselves. So trading is not a get rich quick scheme, and never get to a point where you feel you're invincible. The market will humble you literally. And I think he's just one amongst many people I was told, that committed suicide and really lost a lot of money. A lot of people also were thrown into debt, because of that, because they over leveraged. Okay. Now, don't be overconfident and proud. I've already said this. No matter who you are, no matter how you've mastered your psychology, never believe or assume that, okay, the market now respects me, because I am ABC. Don't be overconfident and proud. Don't rush into trades. You should know this. And if you do all of this, I tell you, you're going to be amazing in the market. All right. So that is the end of chapter 2. I'll see you in chapter 3. Cheers.